Are you the only owner of your S corporation and interested in finding out more about ways that you can save taxes and grow your retirement accounts? In this video, I'm talking specifically to sole owners of S corporations, and I'm going to cover and share the screen while I walk you through the different ways you can contribute to your retirement account, and so can your business, and get the write-off. If you're new to my channel, hi, I'm Julie Merrill. I'm a CPA, and I thrive on helping individuals and business owners grow their wealth while saving taxes along the way. Today, I'm talking about retirement, probably one of the biggest topics I have with most of my S-Corp clients, truly trying to understand and detail out how the different contributions and what the limits are for those contributions to retirement are and how they work in the S corporation. So I'm going to share my screen. I have a diagram, and it helps kind of explain the things a little bit easier when I see things graphically. All right, so this silo that you see on the screen represents how much retirement you can fund into your account in a given year. I have 2025 numbers in here, and 2026 numbers are going to be a little bit different, but not that much. So we can go off of that. Just for the maximums, those might change. But kind of looking at this as a flow, if we look at this silo, basically these three colors, pink, blue, and yellow, as the three ways money can go into your retirement account in one tax year. We do have an annual maximum of all three of these ways. In 2025, it's 70,000, but there's a catch up if you're over 50. So a lot of times when you're over 50, you get to put in more than if you're under 50. I'm going to kind of scroll down here because I want to start at the bottom and work my way up. The bottom is the most common, and then the top is the least common. If you come down here to the yellow section right here, we're just going to focus on this right now. So this is the traditional way we think of putting money into a retirement account. If you've worked for an employer, they had a retirement policy, it came out of your paycheck, and you were able to contribute. We're going to talk about matching in a second, but just you as the employee were able to defer some of those taxes on your wages by putting money into a retirement account. Now they typically have Roth accounts as well. And so if you're lucky and you work for an employer, you have that choice. As an S-Corp owner, you set up your own plan. And all the plans out there right now, most of them in this space, they offer both these buckets. So when I talk about buckets, I'm talking about a pre-tax bucket, like your traditional 401k. So when we put money in it, our taxable income comes down, we get a tax break in the current year, or a Roth bucket. So while we don't get a tax break when we put money into a Roth bucket in the current year, it's now growing tax-free. And if when we take it out when we're retirement age, there's no tax on anything that we've taken out of the account. So Roth is always like a great way. The younger you are, the sooner putting money into it, the longer you have it to grow this like tax-free growth vehicle. But because you don't get a tax break, sometimes we're playing which bucket these go into. So when you set up your owner 401k, which is what you set up, what we prefer to set up versus a SEP. Owner 401ks, all the big custodians have them. Even some of the self-directed custodians have them, where you can set up both this pre-tax account and a post-tax account underneath your business 401k policy. Okay, so the employee is you. On an S-Corp, you're on salary. So we have a paycheck, we have a W-2, and you as the employee can be contributing this part into your 401k. So right now for 2025, the maximum is $23,500. And again, there's a catch-up, $7,500 catch-up if you're 50 or over. That's coming out of your money as the employee, going from your paycheck and then basically going into these buckets. And you can see here I have pre-tax, post-tax, because it does then affect the W-2. So when we look at a timeline for this piece, we're really critical because the timeline for the employee contribution, and a lot of times they call them salary deferrals, same thing, is within the tax year. So if you're in December and you're wanting to do this, it has to be done before the end of the year, so it gets on your W-2. And we know the W-2 is issued in January, so this is very time restricted based on it has to happen during the tax year, it has to be incorporated into payroll, and the money has to come out during that tax year. So timeline-wise, before 12/31, any of these have to run through a payroll run and show this employee contribution. Do you have to put in the max? No, but this is the maximum allowed based on your age and the tax year. So again, this changes each year. Typically goes up a little bit. It's been going up like 500 a year. So we'll watch that. But this is the 25 limit. Okay, so now I want to look at the second one. So when you've worked for an employer, kind of going to go back to that same analogy. When you put money in, a lot of times they match. So maybe they're matching 4%, maybe they're matching 7%, maybe they're matching 2%. So as the employer, now you need to kind of take off the employee hat and put on the CEO hat, because now you're looking as the employer, as the S corporation runner. So we have the company can match or profit share up to 25% of the total wages. So let's just easy numbers. Say you paid yourself $100,000 in a year on the W-2. The company could put in $25,000 additional funds just from the company piece into your retirement account. Okay. Now, ideally, we would love to have it go straight into the Roth. And while this is allowed from the IRS code, many of these owner 401ks still aren't allowing it. So sometimes we're having to put it into the traditional. I'm expecting this to be changed though in the next year or two, because it is something that has been rolled out by the IRS where it's allowed from the employer profit sharing to go into the Roth bucket, but it does create taxable income for the employee, which is you, because again, we're putting in post-tax money. But no matter what bucket it goes in, this is the cool part. This profit sharing or matching from the employer side is a deduction on the business. So the business gets to write it off no matter what bucket you as the employee decide to put it in. And here is the biggest benefit of this. So timeline's different. It doesn't go on your W-2. And so we don't have to have this happen before the end of the year. The timeline on the company part, the employer contributions, isn't January to December. It is up until the date you file your tax return. So you could be on extension filing in September and just funding that blue piece, this piece right here, into your account before you file your tax return. Now, key part is this account needs to be open before the end of the year so you can actually go back and apply it to the prior year. So if you're watching this video in December, you don't have an owner 401k set up yet, you're the only employee in your S corporation, get these accounts set up. You can go to a Schwab or a Vanguard. They all have them. There's no charge. Have them open so that when you go to file your tax return in 6-9 months, you have the accounts in place. And you're like, hey, I have a little extra cash. I'm going to put money into this bucket. And you can do that later. You don't have to do it during the year. So it gives you a little more flexibility. Again, going back, the employee part is going to have an annual max of $23,500 for 2025. Or if you're 50, 31, so another $7,500. Has to run through payroll, has to happen before December. The employer match, the company match, can happen anytime until you file a timely file return. So either by the original due date of the return or on extension, the extension due date when you file. If the account was open from the prior year, and we can only do 25% of the wages. Now, here is one thing though, because I'm only doing this video for solo owners. If you have other employees, the solo 401k doesn't work. Now you could put your spouse on it, but we're not talking about we're talking about non-related employees. So we would have to have a different plan altogether. But one of the things with retirement benefits in general is that if you profit share or do matching, it has to be non-discriminatory, meaning if you do a 20% match for you as the CEO and you have employees, you have to do a 20% match for them too. So whatever you do is across the board. You can't give one person more or other on this type of plan. So that's just something to know. But if you're the only owner, you kind of have freedom to make this decision, and you have a little bit more time to make this employer contribution part. Okay. Now I just want to cover the pink part up here. So this part, if the plan allows it, the employee can contribute post-tax money to kind of make up the difference to get to the maximum for the year. Why is this kind of popular? Because sometimes we'll see basically, maybe you had a big cash year and you're wanting to really start super funding your retirement account. We're going to try to get you to the limit, right? If that's something you want to do. And then you could even then maybe like mega backdoor Roth this, convert it all to a Roth if some of it was pre-tax. There is this opportunity, again, if the plan allows it, because most of the time, to be honest, like we're doing a reasonable salary down here for the employees. So we're kind of capping out on this yellow section at 23 or 31,000. And then maybe we're at like 25,000 here if we're doing 25% of wages. So we're still under this limit most of the time, unless we've got like doctors or attorneys that are having to pay themselves a little bit more as reasonable salary. So that is an option, not as common, but you do have those three options. So I kind of just want to go back through it. Let me make it a little bit smaller again. So this funnel, these three colors are the three different ways you can put money into your retirement. You can do the employee, also known as a salary deferral, employee contribution, has to run through payroll, has to be done before the end of the year. So it's on the W-2, and you can put it in the pre-tax or post-tax bucket if you have those accounts set up and your plan was adopted with that. The company part can be contributed anytime up into a timely filed return. So it can happen the following year until the filing deadline, or if you're on extension, the extension deadline. The key is, though, the account needs to be set up in the tax year that it's going to go back to. So we definitely want to open it, even if we're not putting any money in it, so we have the opportunity to make that decision later, because you might have cash later, even if you don't have it right now. And then if you're really in the mode and goals to max out your retirement every year and your plan allows it, I mean, if you're setting up your plan, you can make it allow this, right? That you can do this kind of post-tax super funding so you can get up to the limit every year. Okay, so hope this was helpful. This is something that I talk about with my clients all the time. It's not an easy concept to really understand and grasp. And then we haven't even gotten into the details in like your payroll provider to see how it goes in. And it's confusing, right? It's confusing on, which part goes in the W-2, which part doesn't, what's the limit here or there. And so hopefully this was helpful and gave you some clarification. I'm curious, if you're a sole owner of your S corporation, are you implementing 1, 2, or 3 of these strategies to fund your retirement account? Let us know in the comments below and tell us your experience. Was this helpful? Did this help explain or clarify things that maybe were confusing in the past for you? I hope so. And I hope that now you can, with more education and more knowledge, know exactly how you can really max that out, get more tax write-offs, or grow your wealth and start building more tax-free retirement accounts through funding your Roth. If you like this video, ring the bell, follow my channel. I'm Julie Merrill. I'm a CPA. I jump on here on YouTube trying to get weekly videos out for you so I can share my knowledge, help you grow your wealth, and save taxes along the way. I'll see you next time.